Good afternoon. Thank you very much, Mello, for having us here today. I am going to talk to you about technology. You can see from this really beautifully worded opening slide that we weren't entirely sure what the title was going to be, so I shall do it as we go along. For those that don't know the Polar Capital Technology Trust, this is a very venerable investment trust. I took over managing it in 2006. I joined Polar a few years earlier than that. We can talk about the team and the process very briefly. But it's been my privilege and pleasure to manage this through ups and downs. And obviously, as you know, I'm sure there's been a few more ups than there have been downs over recent years. For those that don't know Polar, we're a rapidly growing boutique fund manager. And one of our largest franchises has been consistently the technology one. And in fact, the business was built on the technology franchise. The founders of Polar Capital were the managers of the Henderson technology franchise in the 90s. Today, we're a team of 7, soon to be 8. We are the largest technology team in Europe, and we run, I think, the second most amount of money under management across a range of 3 products. I'm here to talk about the trust, but really my comments will be generic to the technology space and how we see it. We have an open-ended fund, domiciled in Dublin, which is today larger than the trust, actually, and a more recently launched product that's designed to target companies involved in AI, companies within the technology industry, but also outside of it. We see lots of trends occurring today that aren't necessarily accessible to us as tech investors, that we wanted a vehicle to be able to invest in those opportunities as they arose. And so we have an automation and AI fund as well. It's a team that's, Nick and I have been working together now for more than 10 years. In fact, 12 years, this is our 12th year together. He is the lead manager on the Dublin fund, I'm the manager on the investment trust. Bunch of very smart people working for us, and we're really the key to our process is having feet on the street and kissing a lot of frogs. More to it obviously than kissing frogs, but the idea of taking a 4,000 stock universe and driving it down into roughly 110 stocks in the investment trust today does involve thinking outside of the box, thinking about big trends that you see in the market, and then really whittling down that list. And for us, the most important part of this process really is identifying key themes. And we'll talk about those themes, or at least some of them today. And then trying to identify pure plays on those themes, trying to avoid last generation winners that often look cheap but aren't, and trying to avoid public venture capital. Having said that, we are proud owners of a few Uber shares. So we aren't afraid of investing in companies that are loss-making, as long as we can see some kind of plan to get to break even, or if those companies are fully funded. Valuation. I think someone once said that if it was just about valuation, all the fund managers in the world would be accountants. It really isn't that simple. When Google came public, 2 years after it IPO'd, the company generated more in net income than most analysts expect it to have been earning in revenue. So it isn't just about valuation, it's about trying to find attractively valued stocks rather than just always looking for what's cheap. And then building a portfolio, because ultimately we make mistakes. It's one of the genuine advantages that institutional managers have over retail investors. You're probably better than my late father was, but when he invested, he had a pretty basic adage of investing: if he hasn't sold it, he hadn't lost. If all else fails, stick your head in the sand. My favourite example of this was when he bought shares in a business called British Dredging, which went down 90% before he didn't sell it, actually. I think he kind of went to zero. He refused to sell it even after he discovered that it wasn't British and it didn't do any dredging. So institutional managers can take their lumps. We make mistakes, we build it into our process, and what we try to do is provide you with a basket of interesting investments that should be ultimately, as a group, deliver outperformance. And that's what we've done over time. And as I say, sell discipline is critical. Everybody talks about winners in this business. Very few people talk about the mistakes they make and how they deal with them. And we build that into our investment process. This is a very complicated slide, but what I was trying to point out here is that the technology industry is a wonderful proponent of itself. It will tell you that everything's about to change yesterday and that you need to do this and that. And the reason it does that is because people in it, like myself, get very excited about what we do. So you'll be hearing about autonomous vehicles and AI and a whole bunch of very exciting technologies that frankly will have limited impact, we think, or at least in their purest sense, have very limited impact for now, but 10, 20 years down the road, of course, they can be they can become ubiquitous. This is the hype cycle of technology. And so in the late 90s, when people were excited about technology, it was all about the internet. And of course, here we are 20 years on, and what we have today in our homes and on our smartphones is vastly greater than anybody imagined it would be 20 years ago. But before that, we had to wipe out an awful lot of money getting to this point. So that's what the industry does. We try to build, again, our process around it. We don't invest in themes where we believe them to be at the top of the hype cycle. We wait for kind of reality to kick back in. What we do is invest in businesses where we feel that they're inflecting, where change is going from a linear thing to a non-linear thing. And that's the S-curve on the right-hand side. Now, in here, stocks often look expensive because people haven't modeled them correctly. And if you think about just examples in your own lives, there was a day where one day you had a CRT television and the big TVs with the big backs on them, and then one day there wasn't. And believe it or not, the market went from 0% penetrated to flat panel TV to about 50% penetrated in about 3 years. And at one point in that process, in that journey, everybody on earth, or at least those that could afford the extra, realized that of course they aren't going to buy a television that used up, a tenth of their living room. And so that's how change occurs. Human beings are herding creatures, and when change occurs, it typically does change in a non-linear way. We are trying to find companies that look expensive. I'd love to find them if they look cheap too, but companies that look expensive, but where they've been mismodeled and where ultimately, like Google, like others, have ended up being very cheap, fantastic investments. Okay, let's get to the main part of the presentation. I had a whole panoply of options to talk to you about today, autonomous vehicles, a whole bunch of things, and AI. So I think you'll be delighted to know that I thought I would focus on Little Chef. Now, for the gourmets in the audience, you'll remember that this was a roadside diner. For those that don't know what I'm talking about, these are Little Chef venues. And just to take everyone back, this business was built in the 50s. And it was an incredible, let's be clear, incredible way to play the growth of cars and miles travelled. And over the next 40 or 50 years, the number of cars on the road and the miles travelled after the war went up tenfold. And this company very cleverly put these diners, these roadside diners, it was by a guy called Sam Alpert, who was actually in the caravanning business, came back from America and discovered that there was this new way of selling stuff out of caravans, built this Little Chef business. And everywhere you drove, there's an adage, I think, that was that the summer holiday hadn't started before you stopped off at Little Chef. Again, it's a little bit before my time, but that's what I read. Anyway, they were all over the A roads and it was all going really well, except for the fact that, well, in fact, let's do the good bit first. So here we are, there's the road, miles travelled. And here's a kind of potted history of Little Chef. And it did really well. You can see the number of locations here. And along the way, it merged with Happy Eater. For those that were, you're either a bit like Yahoo and Google, you're either a Little Chef guy or a Happy Eater girl. These two businesses merged in their heyday. It was very much like AOL Time Warner. They both went to zero, but it was a really happy period for the company. They introduced the Olympic breakfast, which one of my slightly tubby friends tells me was the happiest days of his life. And anyway, we got to the peak in 1899. Now, the story here, of course, is that all was not well in the house of Little Chef, because in the same year that the business was built, the first motorway, the M1, was started. And of course, motorways ended up being the undoing of this business. Many of the A roads that the Little Chefs were situated on were bypassed. They became B roads. Cars became more comfortable, more reliable, and faster. And people ended up changing the way that they behaved. And so you ended up with a business that on paper it was looking fine. It went, Trust House 40 bought it. It was all going great. And then it went into reverse. People's behaviours changed. And it didn't really matter what happened next. They changed their logo. So there's a snazzier Little Chef guy up there. And they changed the menu and they changed the curtains and people didn't want to have check. Anyway, who cares? The point was we were on motorways. And so the real sort of sadness of this story is that it changes hands, ultimately goes to zero. But the basic proposition of the company was correct. The number of miles traveled went through the roof. Everybody had a car. The issue was ultimately we use cars differently. And that today, only 6% of miles traveled are over 25-mile journeys. In other words, all of the incremental traffic that went onto Britain's roads was about short journeys. It wasn't about long journeys. And all of a sudden, if you're taking a half-an-hour journey, the idea of stopping off for a bite to eat for an hour doesn't make an awful lot of sense. And so this whole business, this whole business that was, all right, is meant to be a bit of comedy to sort of open up the pitch, but it was undone by technology change and by a different mode of distribution. There we go, another effort. That, of course, is a parable to where we are today with the internet. And we're not talking about motorways and cars, obviously. We're talking about smartphones and we're talking about the internet. The internet gets faster and faster. The core of the internet is getting faster every day. And just think about the last mile, the smartphone. In fact, as I was coming in here, I wanted to pull up my Bloomberg just to see how we were doing today. See, I can do live attribution on my Bloomberg app on my smartphone. And all of a sudden, I have a new phone. I haven't quite set it up properly, so I couldn't access my app. And I realized that made me sad. My behavior and my expectations have changed. I now need to have live attribution. 10 years ago, I used to have 17 spreadsheets on my PC at work that would just about give me an approximation to how we were doing. And now I have an app on my smartphone that gives me live attribution. And that's really what's happened in this last 10 or 15 years, is that smartphones have changed our expectations, our behavior. They've changed consumer experiences. We don't get in cars anymore to go to shops to find that things aren't in stock. We don't go to shops with people working in them that don't know anything about the products that we're interested in. We go online, we can see peer reviews, we're empowered. And anyone that sits in this kind of middle part of a centralized network is in trouble. And so the person who used to run the cab office, the travel agent, the bank manager, these roles are becoming irrelevant in a world where I can seek peer reviews and move to a model which is much more like a distributed network here. And of course, this is the history of the internet in 3 pictures, but really is a blueprint for how disruption is occurring everywhere in the world. And there was lots of disruption before the smartphone, but the smartphone numbers are pretty staggering. And so today, 2.7 billion people in the world have smartphones. On average, they spend 3.5 hours a day on those devices. I'll let you into a secret. I'm on the higher end of the average. But so is my wife, so she's okay about that. And we're in a situation today where we have very large networks, a few very large networks capturing the vast majority of our activity online. And of course, this is very different to what the internet was first thought of. It was very much a long tail. Everybody could go to the internet. It was very much like the gold rush in the 90s. But today you can see a few examples of the scale required to be a global platform today. And so I went back actually and had a look in history. And it turns out that Facebook, I think Coca-Cola has a few billion customers, but Facebook has 2.7 billion customers going to its network every month. And so you'll read everywhere about this company's this, that, and the other, and it hasn't done all these things, and regulation is in the headlines every day. But this is a business that has 2.7 billion people visiting its properties every month. So I went back in history and had a quick little look about, what other, is there any precedent for this? And the best I could find was the British Empire, at the peak of its power, had accounted for about 23% of the world's population. So I think we've all become very used to these large numbers being bandied around. We've become very used to the idea that I can turn up in a city, boot up an app, and press a button, and a taxi will take you somewhere. You don't have to speak the language. You don't need any currency anymore. I mean, it's astonishing. And it's happened in a rate of time that actually has, well, for some people, probably been quite alarming, but you can see in younger demographics, it's just second nature. I read somewhere once that to a child or a baby, a magazine is like a broken iPad, and that sort of had resonance for me. I actually had a very funny experience getting a taxi once down to a client in the Canary Wharf, and dropped me off just before the kind of wall of steel or whatever they used to call that thing, and I jumped out the car, I said, thanks. And the guy's like, you haven't paid me. And of course, I take Uber so regularly that I'd completely forgotten to pay the chap. But thankfully, I had a bit of cash on me. Okay, so let's just drill down into some of the disruption. You'll read about this everywhere. Digital disruption. It was very much the zeitgeist of this technology cycle. But, you know, in the UK, I think 80,000 people lost their jobs last year in retail. Very small amounts of footfall changes change the economics of a store. And if you just think about the number of retailers that have failed, and of course they'll all talk about, you know, the big stuff like Brexit or the currency or whatever it might be, and sometimes they'll talk about the minutiae like, you know, the council parking charges or it was bad weather. But nobody will talk about the elephant in the room, which is that actually the retail experience sucks. And so if you're a coffee shop, you're doing just fine. You know, so the number of Costa coffees over the last 10 years, has tripled or whatever it is. There are coffee shops everywhere. And actually, it's quite an interesting segue just to mention the fact that when people talk about technology and they think about all those jobs that will be lost, and ignore for the moment that the US is currently full employment, you know, who knew that there would be this many people making coffee for a living? Not me. And so I'm an optimist as it relates to technology taking jobs, but that's because it's not doing that much in fund management yet. Maybe next year we'll have a different conversation. More disruption. This is interesting. So ride sharing. So Uber and Lyft are in the press again for all the wrong reasons, but interesting. What's happening here is these technologies have been sold as being kind of complementary to mass transit. But actually, each year that these companies are operating in cities, they're actually stealing, they're changing behavior. People that can afford it are not going on the train anymore, they're not going on the bus anymore. And it's a very interesting juxtaposition that when you start to take, a bit like retail, when you start to take 1, 2, 3, 4% of people away from the stores go bust. And in the case of mass transit, if you keep stealing or, you know, moving 1% of people off mass transit systems and into ride-sharing taxis, then the economics of those mass transit systems become very problematic. How about television? I'm sure many of you have got Netflix or maybe Amazon. Some of you may use YouTube, help you make the kitchen table, and you don't have to look at those IKEA, you know, instruction manuals anymore with a magnifying glass. You can just go online and see somebody make the video. And, you know, the numbers of people on these platforms are astonishing, absolutely astonishing. We can talk about some more in depth if you like in Q&A, but ultimately it's coming at the expense of linear TV. And so young people don't watch linear television anymore. And, you know, live events and royal weddings and all of that good stuff for sure. But outside of that, it's all about over-the-top video. It's about mass personalized television that people watch different things at different times. Payments are being disrupted. Advertising is being, completely changed. The idea of using a bunch of people that pressed a button to tell you if they thought an advert was, it just looks ridiculous. Now I have actual direct response. I can see the relevance, the pertinence of an ad from the click-through rate. I can see what the ROI is on a piece of advertising. There's no going back to a world where you used to plaster a bit of paint onto a side of a building and call that advertising. That was the best efforts at that time, but today the advertising, the ROIs are at Facebook, they're at Google. And so lots of disruption. Again, if you're not invested in a tech fund, that's fine. I'm not here to push our product, but I am here to, I suppose, point out the fact that you want to be on the right side of this trade. And so, you know, again, don't have too many little chefs in your portfolio that at any given time can look cheap but are on the wrong side of these disruptive forces. Let's just talk about a few of let's drill down into a few areas. So this is new. I can, as a company now, go direct to a consumer. This just hasn't really happened before. You know, this is like someone who used to plaster a board on them and walk around the street and you would just think they were mad. But now I can go direct to a consumer. I don't have to have distribution like I used to have. You know, before the state owned all of the transmission network, so of course you needed to regulate and have state-owned, or at least that's how television began. But now the internet is open and I can just go direct to a consumer. What about Tesla? Although they seem to be having some issues right now, but nonetheless, try to avoid the distribution network for cars. Amazon, its own line of batteries, its own line of leads, peripherals for computers. You may not know, but Amazon has the highest market share of batteries sold online now. And so disruptive to brands. If you're not the very best brand, you might be in trouble. You see it in lots of other areas, in razors and so on, where markets that were once duopolies are now coming under attack from a bunch of businesses that are funded or whatever, well funded, but also able to go direct to consumers. We've got freemium. So this is interesting. So a world where you don't have to buy something, you can try it, and then if you like it, you can then become a paying customer. Again, this is all made possible by the internet, by the cloud, by smartphones. And so I'm sure you're all very aware, particularly the parents probably in the room, about Fortnite. This is a business that was now last year the largest grossing computer game of all time, and it did it by giving the game away and ultimately monetizing people by add-on purchases, that costumes for their characters and various other paraphernalia that had nothing to do with the core gameplay. And that's unusual. Tinder, again, you probably don't know, well, you probably do know what Tinder is, but I won't spend too much time on it. But I mean, this is where a lot of people meet, and then a lot more people meet, and so on. This has 2 billion views a day, and the business is free. But if you want to be able to go back and not this way and that way, and you've made a mistake in terms of you missed somebody out on the platform, there are ways to monetize you. Ultimately, these are massive networks that bring buyers and sellers together, and where the entry price is free. This is compelling stuff, but very disruptive to businesses that used to sell things. And so this is very much, if you really, success-based pricing. And for a consumer, it's astonishing. We get to use these things, try them, and then move on if we don't like them. But if you get it right, if you're EA and you launch Apex Legends, you really can have 25 million people playing your game after 2 weeks. It's quite astonishing times. And then following freemium, then of course you move into subscription. So I like it, and now I'm going to become a customer. And so something like Spotify is a good example of this model, where rather than buying things, buying 8 albums and then having to work out where I'm going to put that album and where I'm going to play it, or I can't play it in the car and in the house at the same time. So my mother-in-law was round last night, and she was a bit sad because Doris Day had passed away. So she said, "Oh, have you got any Doris Day?" Obviously not, but Spotify has. And so within 3 clicks of my phone, we have Doris Day playing in the kitchen, and a little tear in her eye. But more importantly, she was staggered that you could do that with in only 30 seconds. But you can. And for a modest amount of money per month, you access pretty much all the music in the world. And what's interesting about that is that when we can access all the libraries of music in the world, we start to listen to different music, because the algorithm knows a little bit what we might like. And so the number of unique artists that we're listening to is going up. That's interesting, but not interesting if you're a content owner, because all of a sudden, the content that you thought was the best content in the world, well, I think the best content in the world is doing just fine, but the next line down of content is being cannibalized, it's being competing against a bunch of new people that are coming up with music that they can distribute into this new distribution model. Hugely disruptive, fantastic for consumers, but just to remain on the right side of it. The backdrop is obviously for us very exciting, because all of these things are coming together at a time where businesses probably never felt as under threat from change as they probably did in the 90s. Amazon buying Whole Foods was a huge thing. And it really, since then, Amazon has bought PillPack in healthcare and a bunch of other businesses that it has aspirations to disrupt. So companies are very furiously really trying to reinvent themselves. And what that means is having an app that people like and use, and being able to take payment. The idea that I have to type in my card online and it's a disaster. I want to be able to just put my fingerprint on the thing and check out. My tolerance for waiting for anything, sadly, is collapsing. And the smartphone is a large part of that, not entirely, some of it's personality based. So fantastic. We see cloud growth. The cloud that used to be something that people were nervous about is now the enabler of that disruption. So if I'm going to get an app and I'm going to have it changing every day and iterating regularly, because I can't produce a game and then leave it for a year, I've got to keep iterating and developing the game, because that's what my audience expects, then I need to have it in the cloud. I need to push it out from the cloud. The days of walking into a shop and buying a computer game was basically dead on arrival is gone. And so lots of money needing to be spent by incumbent businesses and by new companies trying to disrupt the market. And on the other side of the equation, we see lots of M&A, because companies like IBM, for example, that I don't think are in a great position. They're exposed to the old way of compute and need something new to tell their clients about. They buy Red Hat, which we owned in our portfolio, which is one of the biggest software deals of last year, this year, for a very significant premium. More of that we expect to continue. M&A is really the way that incumbents deal with their age. They use their balance sheets to try and reinvent themselves. AI, not enough time to talk about it really, but some astonishing stuff happening. It's very early in AI, but we launched a fund against it because we think the long-term promise is real. So right now, the idea that computers will be able to, match humans and in some general purpose AI is miles away. It's a pipe dream. But in very narrow fields, they can do it already. And so you probably read about skin cancer detection. It's better to really have a Google algorithm looking at skin cancer than it is to have a third-rate doctor. Now, if you've got the best doctor, it's fine. But if you haven't got the best doctor, it's not fine. And so there's a real-world example. This is a debate happening in radiology right now, where apparently the average radiologist has about 4 seconds to look at a scan. 4 seconds. So please God, you'll be fine. But if you ever need to have a radiologist look at you, you're pretty much giving you 4 seconds of his time. And apparently, according to a study we read recently, when presented with when bad images, mistakes are made 30% of the time. That's not good. And the reason is not because the human's not capable, it's because you're being asked to make a decision in 4 seconds. So that's where the AI vision that I have comes in, which is an augmentation where the machine can look at the images and help the human and take the easy ones off the human's hand so that the human can then focus on the trickier images. And we should all be winners from that trade. The autonomous vehicle is going to be a key area for AI going forwards. I think this is a longer term thing than perhaps the market expects. Just because of the lots of things, but legal and a whole bunch of other technology challenges that need to be solved. But think about the car for a second. The car is utilized 5% of the time. It's a depreciating asset. It sits on your drive. At some point, what might be for some people a wealth-bearing asset could end up looking like an ignorance-bearing asset. Why own something that depreciates when you can click a button on your phone and take an Uber to wherever you need? And so we're not there yet, but there is a point. So just to put you in the picture, Google is, I think now their product, their company Waymo has done something like 10 million miles of autonomous vehicle travel. So it's happening with a human driver supervising, obviously, has simulated more like 7 billion miles traveled. So the technology capability is making progress. The other stuff will have to follow later. But at some point, and it's true for the radiologist as it's true for the car, the data will tell you that all accidents are being caused by humans, right? At which point, it would be fair to assume that humans are legislated off the road. And so again, not today, probably not for another 20 or 30 years, but that must happen. As the technology capabilities converge. And so it takes you back to the little chef a bit, really, which is that this disruption becomes very widely felt, not just in the car, but what about, let's take trucking. Let's take something really generic like trucking. A big industry where most of in the US, domestic freight is carried by trucks. And at some point, you'll have trucks that can effectively can do most of the churning themselves, not platooning, not the kind of fudges that people are talking about today, but a world where trucks can drive themselves. The implications are obvious in some senses. There are a lot of jobs at risk. It's not a particularly attractive job. Young people don't want to do it. There's a shortage of truck drivers right now. But what does it mean for rail? If you can have trucks that don't need human influence, then all of a sudden the economics of trucks versus rail changes dramatically. What about supply chains that have to be completely rethought because a truck can travel and work through the night? And then what about all those towns and businesses that have sprung up over the years to service truckers that need to break up their journeys legally and for needing to pop to the toilet possibly or eat some dinner? And what happens to those towns when the trucks don't stop there? So this disruption starts with technology, but it becomes ever more pervasive. I was going to take you through a few more slides and then maybe just leave some time for Q&A. Our own portfolios, we think about the world thematically. I mentioned it before, and we have 8 core themes. Many of these we've touched on already, so don't panic. I'm not going to take you through each of them in depth. E-commerce, here we are 20 years on or whatever it was since I became an eBay member. And here we are, maybe a little longer than that. And yet, e-commerce is still relatively modest penetration of overall retail spending. You probably would think or guess it might be 20 or 30, but it's really not. It really is about 10, 11, 12%. In the UK, it's a bit higher. In other countries, it's a bit lower. In the US, it's still around 10, 11% of retail sales. Every year we roughly take 1% from offline to online. So again, think about the retail experience and think about when you hear retailers telling you that it's all going to be all right because I've got a new loyalty card coming or I've got a new proposition. Just think about for a moment what happens when 1% of footfall continues to move away from a business with high fixed costs. Nothing good. And so I would expect more pain to be felt there. E-commerce is dragging up the payment story as well as lots of other things like cashless payment. It's so much easier to pay by credit card or debit card today because there's a little thing in front of me at the Pret-a-Manger. I just press my thing and off we go. I've been to a few places recently, in admittedly some of the trendier parts of London. I'm not sure how I got in, but I did, where they actually refuse to take cash. We're moving into a world where people once refused to take payments of cards and now are refusing to take cash. Cash costs money to manage. It has theft. There's all sorts of things that go with cash that get resolved by paying MasterCard or Visa a modest amount of money. We own both Master and Visa in our portfolios. Advertising we've talked about already. Alphabet, Google and Facebook are picking up 90% or thereabouts of every incremental dollar being spent online. That's what's obviously having an impact on regulation or the spectre of regulation for both businesses. It's that they are fairly dominant winners in the online marketing advertising world. I don't think they've done anything wrong or beyond the question of content on their platforms, but ultimately the reason that they've done so well is because they have the largest reach, they capture the most amount of time spent, and they're really quite good actually at delivering ads that have some relevance. Security is a kind of evergreen investment theme. This one is more complicated because of the shift away from the on-premise computing world to the cloud world. But still we have exposure in our portfolios. The cloud is really where the action is. This is a new form of compute that has become now roughly around 20% penetrated as a percentage of total computing in the world. I think that this is much like electricity was in the 19th century, where all the power was once produced in a DC form and then went to AC with 10% left for DC backup. That to me feels about right. As it relates to the cloud, we're going to have some compute that's still being done on premise, but most of it's going to be done in the cloud. In the same way that electricity is generated from a power plant, many miles from where we live, and that's exactly the model that Amazon and Google and Alibaba are really using. Microsoft today. AI will dovetail into that because most of the AI workloads will be managed in the cloud. Other stuff, the software rental model has changed the dynamics of that business. We've got lots of exposure here. Genuinely, businesses in software today have got more knowledge about verticals than their customers do. And so we're hugely excited about a number of apps here that would have been linked in a few years ago, but today are companies like ServiceNow, Salesforce.com, and some more smaller mid-cap companies. Gaming software we've touched on already. Robotics, fantastic secular story. Ultimately, it comes down to technology improvement in things like sensors, reduction gears, a whole bunch of key enabling technologies that have made it much safer and much faster to recalibrate, and much cheaper to recalibrate robots that can now be used alongside human workforces, and that's critical. And so, again, I haven't time to go into it, but this idea of dynamic supply chains in a world where you can see your revenue, your order book in real time. So why would I build PlayStation 3s or 4s if nobody wants them? Let's switch the line and make some Xboxes. And by the way, this happens. In an Amazon warehouse, the humans stay still, but the robotic pickers take the vertical stacks to the humans with the stuff that people are buying now. So things that were static 20 years ago, 30 years ago, forever, have become much more dynamic. Our themes, obviously, over time will vary depending on how we feel about them, but you can see on here that right now, software is at the very top of the tree. Quickly on Apple, and then I'm going to kind of call it up, and then we can do some Q&A. Apple is probably the best investment I ever made. I bought it on the 2nd of May 2003, which is the day after I joined Polar. Had I just left it alone, I probably wouldn't be here today. I'd be on a beach somewhere with Apple phone, Apple iPad, and whatever. Thankfully, I did keep quite a lot of it. It's still around 4% of our portfolio. This is still one of the best companies in the world. Has been generating more than the entire industry, smartphone industry's profits, has a mass affluent audience that are frankly relatively insensitive to prices of their products, and they have this wonderful recurring revenue stream that's growing in their revenue mix. Anyway, I just wanted to make a quick mention of this because the smartphone industry has now moved into negative territory. It's now shrinking, and Apple is finding that they're going a bit tougher. We've been reducing our position. If this wasn't Apple and this was some other business, a Nokia or a BlackBerry or whatever it might be, without the audience or the recurring revenues, we might be at zero today. But it's a very big part of our benchmark. I include it because it still feels very pertinent. But I think that this is becoming a more difficult stock for us to hold on to. Right, I think with that, I'm going to have to skip these. And if I may, open it. Well, I think I'm supposed to bring you back up. So hopefully that was interesting.
It's very easy to kind of fall in love with the technology itself. But as an investor, you need to make money out of it. So, I mean, you could take Uber as an example. Uber has transformed the world, but how much profit is it going to make? How can you judge whether you're actually going to make money out of these things?
That's a great question. And I do, whenever I have a technical issue, like, maybe not now, but with the kids, and trying to get the TV on, I do remind them that I'm not a technologist, I'm a technology investor. And they are very different things. So I appreciate the question. So the answer to that is, it's all about making money. My job is ultimately to deliver superior returns for a given amount of risk, and for my clients. And if we do a good job, then you'll pay us for that, and if not, you'll find someone else to do it. It's pretty straightforward. I think about the job. I remind my team every year we're like Premier League footballers that you've never heard of. If you're a striker in a Premier League football team, the job is to score goals. It's very straightforward. You can talk about the game, you can pass the ball sideways, but ultimately you're in the business to score goals. If you don't score goals, you probably shouldn't be in the team, and you won't be, of course, 2 or 3 seasons down the road. So we are genuinely laser focused on the making money bit. I think there are some other features that go with being a decent fund manager, if not the best, but a decent fund manager. And one of them is, for me in technology, is fear of missing out. So I think it matters a lot that you don't miss out on the big winners of a cycle. And so we can come back to that. I think Uber has the potential to be a big winner of a cycle, so we made an investment in it. So how do we make sure? We can't make sure. How do we stack the odds up in our favor? And the answer is to use the S-curve. So we don't invest in blue sky companies. We're not interested in investing in companies that have a great technology, but at some point the market will gravitate towards you. There's just too much uncertainty there for us, and it's best left to the venture capital industry, where the hit rate needs to be very different to the one in my world. And again, if I get 60% of my decisions right, I'm a hero. In the venture capital world, you could probably get 10 or 15%. I don't know the number, but it's a lot lower, because if you catch a Google, you've made enough money to cover all of your sins and your other. It's a different type of investment. So we are focusing on companies where the theme or the technology has already reached an inflection point where it's not going to zero. So if you're buying stocks where the theme, online advertising, is already at 10% of a market, that's a very different risk profile to investing in something that is 1% of a market and could go to 50, 70, 100. So we leave the very high risk stuff to other people. The other question might be, if I took the flip side of your question, is also ensuring that you don't overstay your welcome in companies that tell you that they're still going to be relevant, but aren't. And you didn't ask it, so I won't spend too long on it. But that is as critical to the way that we invest as then avoiding the blue sky. So how do we get to Uber? The answer with Uber is there are a handful of companies in our portfolio, one of them is Netflix, that require capital, that are loss-making businesses that have the potential to change the world. And I think one of the tests I do is I've been doing this a long time. So I did this before I actually had real children. I sometimes just visualized not real children. The tap on the shoulder test, which is that when I miss Uber and it ends up becoming 5% of miles traveled by humankind, and I get my son tapping my shoulder and saying to me, so Dad, I know when you used to run a tech fund, yeah. How much of the tech fund did you have in Uber, Dad? And I said, well, not so much. How much? Did you have 1p for every pound? No, son, I didn't. So this test is a very useful litmus test for me. So no one is going to ask me about a whole bunch of loss-making software companies that may or may not make it. But as it relates to a handful of businesses, Netflix, Tesla, and now Uber, I think it's right for us to assume a null hypothesis that says, I'm going to buy some of this, not very much, because I'd really like to see how it plays out. And so we don't own any Tesla. But we do own a bit of Uber, and we do own a small slice of Netflix.
I am a shareholder, by the way.
Oh, good.
How do you find the UK as an investment destination for technology companies? And is there any ambition amongst those companies to become the next Uber or Google or Tesla?
That's a great question. I mean, I didn't quite get to the geographic breakdown in the portfolio, but if I do, it will answer your question, or at least part of your question. Let's see if I can find it. Oh yeah, down at the bottom. So you can see that we have 1.3% of our portfolio in the UK, which probably tells you all you need to know about our view of listed UK technology. Now, it's not to say that other fund managers can't find interesting assets, but you know, we have okay. So if you asked me that question 10 years ago, we would have had a lot more in the UK. We would have had a lot more in Europe. 10 years ago was before, maybe, or 15 years ago was before the commercial internet really happened. And the internet is really, as I've covered, I hope, to death, about large networks, massive networks. And those massive networks today, at least as they relate to the internet, are in the US and China, with the odd exception, but really that's where they are. And so my European, my UK, my Japanese, all of those weightings have diminished over time, because without the internet, I don't think the technology sector would be very interesting. So, because without the internet, the smartphone would just be a phone. Now, I actually sometimes ask this question, what would you do with your PC if it wasn't connected to the internet? It's actually quite funny to think what we used to do. We would play Hearts, which is a game that used to come with the operating system. And we might type some letters and do a little bit of Excel. And of course, the world has obviously moved on. So, do the companies have the aspiration? They may well do. And Facebook, for example, I think announced recently, or was it Google? I mean, Google has a huge HQ in King's Cross. I think the UK has actually done a pretty darn good job in terms of, you know, having a very talented bunch of people that can work for tech companies. I also think, my understanding is there's some pretty exciting privates out there too. I think the issue is that for me as a public market investor, many of the most interesting assets don't make it to public markets. One of the best examples of that was one of the predecessor companies for Illumina, which you might have heard of, is one of the biggest gene sequencing businesses. You know, one of the predecessor businesses, if not the most important part of that, was a UK-based business, and they get bought. And I think one of my peers, Katie Potts at Herald, sometimes bemoans the fact that the very best assets get picked off. You know, they get plucked from the tree a bit early. So, from my perspective, you know, we go to where the best ideas, where the best technologies are. If they turned up in the UK, we'd be very happy to come back here. The one thing I would say about the UK that gives me some concern is the depth of the market. You know, it's a pretty thin market. You know, I have a tiny position in Ocado. I have a pretty small position in a company called First Derivatives. I mean, these are nice businesses. We own them in our trust. They're very hard to buy or sell. And so I think there is a question mark about how deep the market is and whether or not that's putting some other institutional investors off. But anyway, that was a very long-winded answer, so I apologise.
Is there a risk that we will see the dot-com bubble again, when so many businesses were valued on the assumption that they would dominate the sector, and it just couldn't happen? It was physically impossible. And secondly, what is your view on SoftBank, which I thought was hoovering up all sorts of startups and so on?
Okay, good questions. So, I mean, there's always a chance of a repeat performance of bubbles. I mean, bubbles are, you know, fear and greed, aren't they? And so I'm not going to do a Gordon Brown and say we've eliminated them, because we clearly haven't. But let's see if I can find the valuation slide. I mean, for those that weren't in the market at that time, it was quite something. I was. And on the left-hand side, you can see the S&P tech sector. You probably can't read it. Apologies for that. But maybe you can. You can see that briefly, for a year or so, we traded around 40 to 50 times forward earnings. And much of that earnings power just completely dematerialized. It just disappeared because we had a kind of... it wasn't a Ponzi scheme, but it was certainly a self-reinforcing thing where, you know, capital is being raised and then I can invest it in blah, blah, blah. And it was all around the internet, you know, 1.0, telecom deregulation. Exciting times at the first bit and, you know, well, I suppose you could say exciting, but not financially after it. So that was the bubble. Now you can see where we are today in aggregate PEs. So we've had a good run recently. Stock markets have had a good run recently. And I'm loath to can't give investment advice about timings and what have you. But what I can say is that in aggregate, the picture looks very different to how it did in the late 90s. Now, within the market, there will always be areas that look expensive or what have you. And so if you look at, say, internet stocks today, this is the left-hand side, actually the Merrill Lynch Internet Index, we use a cash flow multiple as for valuation purposes. You can see actually the valuations in that group are towards the low end of where they've traded over the last 5-6 years. You can buy Google on a near market multiple. You could buy Facebook not long ago at a near market multiple. People are nervous about regulatory risk and the law of large numbers and how will these businesses reinvent themselves, and everybody remembers MySpace and whatever it was that went to zero and thinks, oh, it's going to happen tomorrow. No young people are using Facebook. Of course, they're all using Instagram, so that's just fine. It's like observing that no young people watch BBC Two, because you own the other TV station. So we like the internet space. The valuations there look fine. The risks are not valuation risks. They're earnings risks. They're regulatory risks. They're other things. There's always risks. If you look at the software space, you can see that clearly people are very excited about what's going on in software. We've been excited about this space for a decade, but there's no doubt the valuations have gone up a lot. And we have been reducing our exposure here. Now, this is one metric. This is an EV to revenues. We only use EV to revenue. Like revenues are, like the previous gentleman intimated, you can have billions of revenues at Uber and still lose billions. You'd only use an EV to sales metric for valuation if you didn't have a better metric to use. We use it as an approximation for the truth. So for businesses that are loss-making or building businesses that look like they're loss-making, there's a very important distinction to make. It's a little bit like alcohol. There are people that enjoy drinking, and then there are people that have to drink. We don't try to buy investments that need capital. We invest in businesses where they may be loss-making because they choose to be loss-making. There's a very important difference to draw out. So the EV sales metric is giving way to other. We use that because for many of these companies, they were loss-making. But now companies like Salesforce.com or ServiceNow or some of the bigger names in software, Adobe, these are very profitable cash flow generative businesses. So where we peaked the last time, and it was a pretty nasty experience that followed it, most of these companies were loss-making. If I showed you that chart on a, say, operating cash flow valuation, it would still look elevated, but nothing like as elevated as that. So the question was about, can there be bubbles? And I think the answer is there can be. Are we in the midst of one? I don't think so. I didn't think we were last year. I didn't think we were the year before. I remember what a bubble felt like. In the late 90s, I was asked to go onto a forum like this, but instead of there being, 150 people or whatever we have in the room, it was 10,000 people. And instead of sort of limping up to the stage, they made me run onto it, to the music of Mission Impossible. I don't pick up the voicemail very often, but last I checked, no one's asking me to do that. We don't see tech funds all over the ISA front pages. There are some. Our discount right now on the trust is 6.5 or something like that, 6.5. At the peak of the market, I believe this trust traded on a 20 premium. So I just want to be clear about this. I can't give you investment advice. This is for long term. I bought my shares in PCT on the first day I joined, and I've run them ever since. This is a long-term investment. I think that the most important, there are two things you have to do in investment. You have to make reasonable decisions and you have to get them over the right time frames. And so if you are in this sector, understand it is more volatile than general trusts and global equity funds, because we're just focused on one very important, but one area within the market. And at any given moment, there will be bubbles. Solar power, Bitcoin, whatever. My job is to avoid that rubbish. And to try and deliver you a portfolio of real businesses, knowing that I will make some, but hopefully manageable mistakes along the way.
We've had a terrific presentation here, a lot to think about, and let's have a big round of applause for Ben.